Today, I'm gonna answer a question that Alan and I get all the time, and that is, what are the tax obligations when trading and or investing in shares? Or in other words, how can I calculate how much I'm supposed to pay in tax when I start making money through the stock market? Now, before we get into the specifics of the video, there just has to be a quick disclaimer. As I'm sure you guys have heard a million times here on YouTube, Alan and I are not financial advisors, nor are we tax professionals, and you shouldn't take this as legal or tax advice. This video is merely for educational and entertainment purposes. Now, unlike a salary, where an employer will normally withhold a portion of your pay in order to put it directly to tax, when you buy and sell shares, you are in complete control of that money. So in the event that you actually make a profit, and hopefully you do, you'll need to make sure that you have a certain amount of money put aside so that you can cover your tax obligations when tax time rolls around. This is a similar sort of setup to someone who owns their own business or is self-employed. You won't necessarily have a system set up where you pay your tax as you go, and so at the end of the year, you usually have a larger tax bill, a lump sum that all comes in at once. So to avoid any scares when tax time comes, in today's video, we're going to cover the two main types of taxes you need to pay when you invest in shares, a legal tax law that all Australians can use to lower their tax bill, and how international share trading comes into play. And for any of you who use Stake like I do, or use any one of the other brokerage firms and buy shares internationally, this part will be for you. Now, very quickly, just before we jump into this first point, if you guys find any value whatsoever in the free content Alan and I produce here, we really would appreciate just a gentle tapping of the like button. We hope that's not too much to ask because it really does help us out and it helps push our content to a larger audience. So thank you for anyone who did tap it. Now let's go into the first point. Okay, so there are two main ways you can make money in the share market, and therefore two main ways that the tax wants a portion of that. The first way is called capital gains. Basically, all that means is you bought a share for a certain price, that share then increases in value and you sell it at a higher point than you bought it for. As a very basic example, you bought one share of Apple stock at $100 and then 3 months later you sold it for $130. That $30 worth of profit is your capital gain. The other way you can make money is through dividends. Basically, a dividend is when a company that you own a share of shares their profits with you. Not all shares do have to pay out a dividend, but when they do, it's a periodic payment that goes straight into your brokerage account, as you can see here on my Stake profile. So with both of those ways you can make money, the capital gain and the dividend, they need to be included as taxable income, either when the share is sold for the capital gains portion or when the dividend is paid out for the dividend section. Let's go through an example. Take a look at this tax calculation diagram. Now, if you guys aren't exactly sure what's going on here, don't worry, we made a video a couple of weeks ago explaining this in detail. So make sure that you watch that video so that you understand exactly what's going on. So for this example, let's say you have a pre-tax salary of $60,000 per year. However, at the beginning of the financial year, you also bought $20,000 worth of shares, and about 8 months later, you sold them for $30,000, bringing you a profit or a capital gain of $10,000. Let's also say throughout those 8 months, you also received $1,000 worth of dividends. All you would need to do is add that capital gain of $10,000 and an additional $1,000 worth of dividends to your taxable income. So in this example, that would bring the total taxable income to $71,000. So then you can see by using the diagram, that would increase your tax bill from $9,967 to $13,509. $142. Let's go through another example. Let's say this time you made an absolutely amazing profit. From capital gains alone, you earned $80,000, and on top of that, a further $8,000 from dividends. This time, your taxable income would increase to $148,000. And then, using the diagram, you can see that the bill then comes to $39,827. Now, you might be thinking, damn, that is a huge increase. And it is. So let me tell you one simple legal way to reduce that dramatically. It's appropriately called the capital gains tax discount. And basically what this means is, if you hold a particular asset for more than 12 months, so longer than a year, they'll give you a 50% discount on the capital gains tax, meaning you only need to pay tax on half of the capital gains. So using the example we had before, let's just say you held the shares for longer than a year. Assuming the same amount of profit, $80,000, with the capital gains tax discount, you would only need to put $40,000, 50% of the $80,000, onto your taxable income. So that would mean that your taxable income, rather than being $148,000, is $108,000. Now, bear in mind, this doesn't mean that you don't get the $40,000. It just means that it isn't counted as taxable income. So you get that $40,000 completely tax-free. But anyway, with the $108,000 taxable income, using the diagram, you can see that your tax bill now drops to $25,567. That's almost a saving of $15,000 just for holding the asset a little bit longer. Now, just keep in mind, obviously they were really simple examples of someone who held shares in their own name. There are differences in the way these tax laws apply if the shares were held in a company or in a superannuation and things like that. And keep in mind, we didn't include any deductibles either in this person's hypothetical tax bill. So, international traders, everyone who uses stake, myself included, how does this all impact you? Well, strangely enough, even though the assets are traded overseas, you still are an Australian citizen when it comes to tax. So it is mostly the same. However, there are two main differences that you need to keep in mind. For one, when you're trading in the US specifically, they actually impose a 15% withholding tax on all dividend payments. So as you can see here, here's my dividend payment, but then right after that, I get charged a 15% tax, which the US government takes. And although it mightn't seem like much, it definitely is something to consider. And the other thing to consider, and this applies to all international traders, not the US alone, because you're trading in another currency, it can be a little bit difficult to figure out exactly how much you made when everything's done in a foreign currency. So to save myself the headache and the time of going through and calculating what the equivalence would be in the Australian dollars, I just use ShareSite. So basically, ShareSite have partnered with Stake and a number of the other bigger brokers in Australia, and by exporting your transactions onto their platform, they'll give you a full detailed breakdown of all the information you need to not only know how you're going as an investor, but also to figure out what your tax obligations will be when the time comes. As you can see, they show you your capital gains, dividends, currency gains, and much more, which gives you a real understanding of where you're standing because they take into account the currency differences. And the best thing is, for those of you who are starting out and have less than 10 holdings, it's entirely free. But for those of you who have been doing it a little bit longer, or those of you who are beginners but have a lot of money to start with, I'll put a referral link in the description, and that'll give you a special offer. So be sure to go down, click that subscribe button, click that notification bell, and you'll be the first to know when any new content is posted. But if you can't wait, here's a video that YouTube thinks you'll enjoy, and this one is our latest video. Hopefully one of those apply to you, but if not, I'll see you in the next one.